In this video, I want to share 5 stocks to buy and hold forever. My name is Christophe Nour and I love these businesses. I've been investing in the stock market for almost a decade with a performance of 24% per year. And my biggest gains in the stock market come from these stocks that you buy once and you just hold on for dear life. You hold and you hold and you hold. And these businesses are getting better and better and better. So in this video, I will share 5 stocks that are potential candidates to buy and hold. The first one is the most obvious one. Oh, I've lost you. The first one is the most obvious one. This is Costco. This is the favorite company of late Charlie Munger. This is one of the biggest retailer with a beautiful business model. And if you had invested a couple of years ago with the business, you would have made a lot of money. And this is the stock chart for all years. So since 1982, for 40 years, you would have made a lot of money. At the time, the price was 90 cents. Now it's $900 per share. You just buy once and you hold. And you don't care if there is a dot-com bubble, and you don't care if there is a great financial crisis, and you don't care if there is a COVID. You buy and you hold. Now let me go through the financials of this business. This business is already big. This is a 4 billion market cap, and it can continue to grow at a healthy rate. It can continue to grow 15% per year for the next years, for the next decade. Okay, what is Costco? Well, I suppose you know what Costco is. It's big enough. Costco operates in a membership-based, no-freeze retail model, predicating and offering a select product assortment in bulk quantities at bargain prices. This is a big retailer, and all the members, all the customers, they have a membership card. So at the end of the day, you pay the membership card, the annual membership card, and the price of this membership is going up and up and up, because you know that if you get your membership card, you will get great discounts at Costco. So Costco operates in the following way. This is a big flywheel. Costco buys in big volumes to suppliers, and because they buy in such a big volume, they get a discount. So they get a cheaper price. And the cheaper price is translated into cheaper prices for customers. So customers are happy. You have a low price, life is good. And more customers join with this membership card, this membership fee. So now you have more customers. So Costco can buy another larger volume. So next year, Costco goes to the supplier, asks for larger quantities. And because you ask for larger quantities, you get a bigger discount as a percentage. So the price per unit is reduced. So for the customers, the price per unit is reduced. So customers are even more happy, so happier. And you do that for years and years and years. And they have some margins that are not that high, at 13%, 14%. That is almost half that of Target or Walmart. So compared to competition, as a screener, Costco may not appear with the best margins, but they have a beautiful flywheel effect, a flywheel model, and this flywheel has been working for decades, and it is very likely that the company will continue to be better every year. And that is the reason why Charlie Munger loved it. And they are now going into China, and that may be a big catalyst for future decades, but I would not think it's the best catalyst for the stock. I mean, the stock has been doing great things without going into China. For decades, they wanted to try and go into the Chinese market, but almost every time there were briberies, and Costco does not want to associate with bribes. So they said no and no and no. And now they are trying again. It seems to have picked up. So we'll see what will happen, but the catalyst is here. There are catalysts everywhere. And even if there is no catalyst for the next decade, there is a beautiful flywheel model that will continue. Okay, you have gross margins of, this one, 13%. Operating margin at 3%. This is a retailer, so don't expect big margins here. Net margin 3%, return on investment 16%, return on equity 30%, return on assets 11%. We are talking about some healthy return on investment for quality business, especially since it is a retailer. Now let's talk about the revenue. Revenue going up and to the right. It is very likely that the revenue will continue to increase. Net income up and to the right. Beautiful compounding engine, and it is very likely that it will continue in the future. What about the balance sheet? Well, they have approximately the same amount of cash and debt. Now they have 11 billion of cash, 8 billion of debt, so we are talking about net cash of 3 billion compared to a market cap of $400 billion. So it's as if they didn't have a balance sheet, no major risk, no major opportunity. Now let's talk about operating cash flow, up and to the right. And I believe they will continue to increase in the future. Now free cash flow, same thing, more volatile, but up and to the right. And if you look at the return on invested capital, the ROIC in green, it's consistently at 11, 12, 13, 13, 14, 15, 16. Oh, it's even getting better with years. So you get a consistent business model that improves, that is more efficient over the years. You have some dilutions here and there, but we are talking about less than 1%, so I don't see this as a major risk. The business is very simple. There is a reason why Charlie Munger, one of the best investors in the world, loved this one, and it will continue to go up. The major risk is the valuation. You have a PE ratio of 50, forward PE ratio of 50, price to free cash flow of 60, price to operating cash flow of 35. So yeah, the valuation is high, and that has been one of the latest sadness of Charlie Munger, that was willing to buy more, but the price was just too high. And over the past 10 years, the PE ratio has gone up and gone up and gone up. Before, they had a PE ratio of 20, and then 30, and then 40, and now we're going into 50 territory. So I don't think it is a good buy right now. But if you take a long-term view, like if you want to invest for the next 20 years, I think it's a very good opportunity. But if you are looking for short-term arbitrage, maybe there is a better long-term play. But still, this is a business to buy and hold. If you want to buy and hold for 50 years, this is this one. I mean, this business is unkillable. The second one is, I don't think you know this one, is Cintas. Cintas is a different business model, nothing to do with retail stores, and you see over the past 10 years, the stock is going up and to the right. And if I check all, look at this, monstrous. Since 1983, the stock went from 25 cents to now $200 per share. A beautiful compound engine. Okay, what do they do? This is a big business, 80 billion market cap. What do they do? Cintas is positioned as a one-stop shop that rents and sells uniforms and ancillary products and services such as mops, first aid kits, and fire inspections. This is a boring business model that rents uniforms, like for pharmacies, for doctors, for firefighters, for workers, blue collars, white collars, simple uniforms. You put your logo in the uniform, and if you want to change every year your uniform, you ask them, you rent them, and that's it. And they do everything. They do the delivery. They are in the uniform rental business. And I don't think the rental business is going to be disrupted. Who in the Silicon Valley wants to create a business about uniform rentals? I don't think anybody finds this sexy enough. So this business is very likely to continue to be generating more revenue and continue to grow in the future. Nobody wants to disrupt this one because this is a boring business. And you've seen the performance. This is a business that you buy and you hold. Okay, the margins. Good margins, operating margins at 20%, free cash flow margin at 20%, return on invested capital at 20%, return on equity 40%. That's very, very healthy, very, very good. You have a current ratio of 1.5, so that's healthy. And let's look at the revenue growth, up and to the right. Net income, up and to the right. This is a smooth ride. What about the debt? Okay, the debt, they have let's say 3 billion of debt and almost no cash. So 3 billion of debt compared to 80 billion market cap. That's not a big deal at all. What about the operating cash flow of the business? Up and to the right. This is a smooth ride. And free cash flow, up and to the right. Literally, this business continues to compound and compound and compound. And if you check the return on invested capital, ROIC, it goes from 10, 12, 14, 15, 16, 17, 20. The same thing, economies of scale. This business is getting more efficient. Nobody wants to eat their lunch. This is not a sexy business model. This is a boring industry. Nobody wants to take market share from them, and they are getting better and better and better and better every year. They do some buybacks here and there, but no big deal. Okay, 2%, 3%, that's decent. But same thing as Costco, you have a high valuation. I would say having a PE ratio for this one is a lower risk compared to Costco because you have this runway. Costco was already a big business of 400 billion of market cap. Now we are talking about $80 billion of market cap. So this is a business that over the next decade can double, can triple, can quadruple. If they operate the right way, they can continue to compound. So check it out, do your due diligence for Cintas. This is definitely a business to buy and hold. And I believe in the next 30 years, they will continue to go up because that has been working for decades and decades and decades, and I see no major disruption risks. Okay, next one. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Next one, this is also in a boring industry. We are going to talk about waste management. So who wants to invest in waste management? Who in the Silicon Valley wants to disrupt the waste management industry? I don't think anyone. The market cap is $80 billion. The stock is going up and to the right. If you check all that has been cyclical, they had been hurt in 2000, but still up and to the right. This is a beautiful compound effect. You see this exponential growth over time. Seems like the business has found something that is working nicely as the growth is accelerating, and I believe that the financials back up the stock price. So let me check the financials. Here, growth has accelerated. Here, net income, same thing, up and to the right. You have more cyclicality. The growth is not as good as Costco and Cintas, but this is going up and to the right. What about the debt? They have 60 billion of debt compared to a market cap of 80 billion. Yep, quite a lot of debt actually. So that can be more risky compared to the other ones. And if you compare the operating cash flow, up and to the right, free cash flow, up and to the right, and the return on invested capital, 11, 8, 8, 9, 10, 7, 11, 9. Consistent, let's say 9% ROIC. And they do buybacks almost every year. 2%, 2%, 2%, 2%. So you won't get 30% annual returns. You won't get 20%, but you can get a decent 15% out of this one. That's my opinion. The P ratio is lower because the business quality is lower, but they have a P ratio of 33. Forward P ratio of 25. Valuation could be reasonable for this one actually. So this could be a good buying opportunity. This is not financial advice, but that could be something very, very interesting at the current prices. Maybe you will see some weakness in the next months. That could be something very interesting. And I did not even mention what they do, but I think this is pretty simple. Waste management ranks as the largest integrated provider of traditional solid waste services in the US, operating 260 active landfills and about 300 transfer stations. The company serves residential, commercial, and industrial end markets and is also a leading recycler in North America. They stay where they are good at in the US. Okay, let's continue with the other one, and the other one is maybe my favorite one out of the list. This is TPL. This is Texas Pacific Land. This is not the first time I talk about TPL on this YouTube channel. I think it is the best business model I have ever found and the best stock. The stock has been compounded at 30% per year for decades. And look at this growth, which is just phenomenal. if you had invested in TPL in the 70s, in the 80s, you would have made a lot of money. If you only buy this one and hold, that's it. You are very wealthy. You just have to invest when it's a small company. The market cap is $25 billion. I believe it can grow to a much larger company. So you may think this is big enough. It can be bigger. It can be bigger. The margins are just spectacular because they operate in a royalty business model. The business model is very simple. They have lands and they operate the lands. And they get royalties out of people using their lands. So it turns out that they have lands in Texas. There is oil on these lands, under these lands, and big oil producers come to drill this oil on these lands. And TPL gets a royalty out of this oil drilling. And they also do water services, and both segments are royalty businesses. So gross margins 90%, operating margins 80%, that's phenomenal, just phenomenal. Free cash flow margin 60%. And if you look at the past growth, look at revenue, exponential growth. Net income, exponential growth. Cash, they have a lot of cash, growing cash pile, absolutely no debt. Free cash flow, this one, up and to the right. Operating cash flow, up and to the right. Return on investment is completely astronomical because the business has no assets. This is a royalty business. They just have lands. So the return on investment is just big, huge. Before they did buybacks and now they are doing dividends. So if I check here, cash flow for dividends, yeah, as they reduce the buybacks, before in green this is the buyback. So they bought back 3%, 2%, 3% of the shares and they stopped. It's a shame, but they stopped. And now they are doing dividends. The management is saying that they are doing dividends because valuation is getting too high. So you may destroy value to do buybacks. Maybe that is the case. Now the PE ratio is 50, forward PE ratio of 45. And don't get confused, this business is cyclical. So you can get a good buying opportunity on this one. Now they have a PE ratio of 50. But last year, they had a PE ratio of 25 here. And actually, I bought this business. I'm a shareholder of TPL. I bought here, PE ratio of 20. Again, it went up a lot and then back down. PE ratio of 25. And then it went up a lot and then back down. PE ratio of 25. Here. So this business is cyclical. If you had, out of this list of 5 stocks, if you had to put one on your watch list right now, is TPL. Because this is cyclical. This is linked to the oil industry, so that goes up and down. And I believe that this upswing will go down eventually. And you will get the opportunity to buy this business at a PE of 25, 26, 27. So a reasonable valuation for a business that is excellent and has no competition and has a beautiful moat. They have lands, they can drill some oil, they don't have any cost, and that they have software like margins. That's phenomenal. This is definitely a business that I'm never selling. This is a stock that I'm never selling actually. I just buy and hold. So I've done it since 2020. So since 2020 it's been 4 years, almost 5 years. So yeah, this life is good. Life is good. Oh yeah, 4 years. And I plan to just continue to buy as it drops and hold. And the last one for you is very simple, is Berkshire Hathaway, the company of Warren Buffett, the big conglomerate with the market cap of $1 trillion. Here, this is one of the best companies in the world, one of the biggest companies in the world. This stock is going literally up and to the right. You have one of the best CEOs of all time. If you had invested in the 60s, 70s, 80s, 90s, every decade, you would have made money. Now people argue that if you buy Berkshire Hathaway, it's as if you buy the S&P 500, a typical index, because it's so big, it's hard to outperform. I may agree with that, but you buy the Berkshire Hathaway stock with the best management team in the world. So there is a difference here, and the runway is very, very big on this one. So they will continue. That's a safe 10%. You won't get 30%. Spoiler, you won't get 20% per year. But that's a safe 10%. And most people are good with 10% growth per year because that's safe and you're comfortable and you sleep very well at night. And the difference with most stocks is that Berkshire Hathaway will continue to compound for the next decade, for the next 2 decades, 3 decades, 4 decades. They can continue. This is definitely a buy and hold investment. So maybe you know Berkshire Hathaway, so I can go really fast with the numbers. There are some accounting changes because this is a big conglomerate, but everything goes up to the right. We are talking about one of the most consistent, efficient business model. And now they do some buybacks. They did some buybacks when the stock was undervalued. They have a fortress of cash. They generate some healthy cash flow. They are available in everything. They have a stock portfolio that everybody knows, but they are also in the insurance business, in the railway business, in the reassurance business. This is definitely a stock to buy and hold for decades. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description and I'll see you on the other side.